Good morning, everybody. It is May 23rd, 2022. Welcome to Retirement Income Options and to a lesser extent, Stocks of the Weeks. I throw in a lot of ideas, but today we're going to focus on some option selling ideas. We have quite a few new subscribers here in the last couple of weeks with some articles that I wrote. And I'm really trying to focus on the option selling as a risk management tool for people who haven't been exposed to it. I know that most of the long-term members are selling cash secured puts and covered calls from time to time. And really, we've been able to at least double our portfolio income pretty consistently year over year. And I think that in up years, when the cash secured puts are expiring on us with some regularity, a lot of times we can triple or quadruple our income. I know we've had years like that. I think as we see the volatility here play out this year, and then a new bull market emerge from the bear market, which is always the case, we can probably see mountains of cash into these portfolios. So I want to go over those ideas again with you and make sure that you know where to find them. If you're over at Fundamental Trends, it'll show up in the member content or in the retirement income options. If you are a rare member, you get everything. So you can just go to any section and find it. Over at Margin of Safety Investing, you'll just find it up here. So if you're over at Margin of Safety Investing, just go to the latest articles and it'll be right there for you. They make me put in a nice picture. All right, so we wanted to take a look at the options that we're going to sell on a week-to-week basis. You can really consider these to be buy alerts or sell alerts, trade alerts, because they're all pretty close. Sometimes when I do the option orders, it'll say a price like 2+. You always want to ask for a price that's a little bit higher than the ask at this moment. So with a Metis, maybe the bid ask is 210 and 215. You probably want to try to get 225. And then about every 20 minutes, go ahead and lower the nickel until you get it. So you can just leave it as a good till cancel order. Try to be greedy when you're selling options. Try to get a nickel or a dime more than what's being offered right now, because a lot of times you're going to get it. And I am putting these up much more in real time. In the past, I'd put option trades that you maybe wouldn't get for a week or two. We're trying to get these today or in the next several days, for sure this week. And then these premiums will be real close. And we're making the decisions based on valuation as well as the technical indicators. So these are going to be very close to in real-time trades. One of the things that I would caution you on right now, and I don't know if you've read the other article that I put out, I combined Shooter's major markets that he does for Fundamental Trends and added some of my own things for Margin of Safety Investing, which are also up in a separate article at Fundamental Trends. So all the content is everywhere. It's just different formats depending on where you subscribe. But I want you to all be careful. I think that this stock market rally is going to be short-lived. I think maybe into the first week of June at best. And some of the best technical analysts in the world are saying the same thing. Shooters, selling puts with the idea that might buy them back in pretty quickly. This is from a guy named Thomas DeMark, and I've been following him for a very long time. And he indicates that he was talking to Mark Newton. Well, I've known Mark Newton a very long time, and he's over at Fundstrat now, which I'm a subscriber of. So you take a look at their chart, and he's basically saying you can have up to a 62% retrace, and that's a Fibonacci level. Other Fibonacci levels are 23% and 38%. And I think those are much more likely because as the liquidity drains from the market, it'll be hard to really have more traditional, and that's what this is, a more traditional rebound. So I think that we get a little bit over 4,000 on SPY, 41, 4,200 maybe, and then it comes back down. Then the downtrend resumes. So if you took a look at the article today with the charts with the S&P 500, you will see that I'm pretty concerned about the elevator shafts opening up. And I will show you that here just for a second. This is the combined article of Shooters and mine. we're hitting right on the support that I said that we would hit. And this chart's pretty much been in play for, since late last year sometime. I haven't really made any changes to it. I kind of formatted it a little different here and there. And we're hitting this first significant support and getting a bit of a rebound rally. Somebody asked, what do I mean by the elevator shafts opening up? So if you open up the door of an elevator shaft and there's no elevator there and you jump down, what's going to happen? You don't want to go down an elevator shaft. This market could get destroyed. And I went through some of the technical indicators here. I think that this major resistance right here, X a major recession or black swan event, I think the S&P 500 goes down to around 3,000, maybe a little below, maybe a little above. Shooter says something similar. Oh, this one isn't popping up, but he's got a range here with his golden boxes that you want to be aware of, and it could go a little below 300 on SPY, a little bit above. He has a kind of a best case scenario of 359 on SPY, and that's quite a bit further down. I think the world would have to get really good, really fast for that to happen. Went through QQQ, showed some of the technical indicators. So I do really recommend that you read this article. And we talk about TLT. And one of the things to realize with TLT is that it is basically the smart money, the bond money, telling you what it thinks the long range is. And bond investors typically are the smarter money because they are managing much bigger piles that they have to use asset allocation to satisfy a number of goals for long range investing. And I know that a lot of people say they're long-term investors, but the reality is, man, I get so much pushback when I talk about a year or two out. Oh, what about right now? Man, I hear that so often that I just want to puke a little bit every time I hear it. Look, if you think you're going to outtrade the market on a short-term basis, you are 80% likely to fail unless you have somebody like Shooter on your side and you're taking the time to learn how short-term technicals work. And you're not buying into trader narratives. You're just relying on the systems and the numbers. And what they do is they don't provide any magic formula or any, crystal ball for you. But what they do is they will consistently put the odds on your side. And that's all you can really ask for. Anybody who's asking for perfection is a fool. Anybody who's promising perfection is a liar. Doesn't happen. And in all my years studying fundamentals, which is where I primarily live, and then technicals, which I understand, and quantitative analysis, which I was a quant before being a quant was cool, I will tell you that the biggest thing in the market, all other factors aside, is liquidity. And when the Fed drains the market of liquidity, stocks go down. Now, that doesn't mean that they can't have rebound rallies. Absolutely, they can as assets change hands and asset allocations change. But when liquidity goes down, asset prices go down. That usually leads to the dollar going up. People will say, well, the dollar went up, so asset prices went down. Either way you look at it, strong dollar, low liquidity, asset prices fall. And the opposite is also true. So as the dollar right now is having a little bit of a breather on its rally, come down just a shade, and liquidity hasn't quite drained out of the market yet, right? The Fed hasn't done quantitative tightening yet. We have this window, 2 or 3 weeks maybe, before the quantitative tightening starts, when the liquidity really starts to drain out. That'll probably drive the dollar back up. So you'll have one crowd saying the dollar got stronger, therefore stocks will go down. Another crowd will say, well, liquidity is draining, so stocks are going to go down. I'm just going to tell you that, look, liquidity and the dollar are linked. So when we're flooding the market with dollars, right, that would drive the dollar down and liquidity up and vice versa. So when TLT, I'm not really sure why these aren't popping out, but when TLT is headed down, that means that the market's expecting higher interest rates. And when TLT stabilizes, it means that the market is probably expecting, well, this is where interest rates are about going to stay. Now, the question you should ask yourself is, do we really believe that long-term interest rates are going to go up much and then stay up? Because that would imply a remarkably bullish overall economic sentiment for a long period of time. Well, the long period of time can be marked by an understanding of demographics. Demographics are destiny. And in an upcoming article, I will title Demographics and Robots Are Destiny. I'll talk about why you shouldn't expect an overall massive economic boom. Rather, you're going to see a great divergence. You're going to see some things do very, very well over the next 10, 20 years, a select set of growth assets and a handful of resources. And you're going to see a lot of old economy stuff just get bombed. And if you're on the wrong side, you're going to get crushed. And if you hold on to old ideas about what is good and bad in investing without looking at the numbers, you're going to get smoked. And the biggest part of the narrative out there right now that can hurt you is that tech and growth investing is dead. That's so wrong. It's off the charts wrong. Growth and tech investing is taking a breather. May have gotten ahead of itself with valuations and IPOs and SPACs and stocks with 15% growth rates having 40 PE ratios. The growth rate should be roughly the same as a PE ratio. PE ratio can be a little bit higher. So if your growth rate's 15%, you should almost never have a PE ratio over 30. Peter Lynch always talked about you always want your PEG ratio, price to earnings divided by growth, to be under 2 and as close to 1 as possible. So if the price to earnings ratio is 30, you would say, well, we need at least a 15% growth rate to justify that based on historical interest rates. And if interest rates are a little bit low, maybe you get a little bit more valuation. But in this era where we're coming, where interest rates will be a little higher than 0, but certainly not normal, because inflation isn't going to last, you should really ask yourself, are all these value guys who are talking about defensive assets is that really good for me? It's not. It's never been good for more than a few quarters at a time, ever. The growth assets going back to World War II, even before that, have always been the longer term winners. People say, well, but I saw a study that said that value stocks win. Well, no, not really. If you take a look at the underlying growth fundamentals, what you really want to find are growth assets at value prices. Those are the ones that kill it. It's what Warren Buffett did all those years. He didn't buy no growth companies. He bought growthy, cash-rich companies, high cash flow companies that he could get cheap at some moment in time. And that's what you should do too. Where can you find growth and valuable assets at low prices at a moment in time? And so you have this narrative, this trader's narrative, which is saying, hey, get out of growth stocks. A, because they're betting against them. And B, they're very willing to buy them at the low enough price. So they're trying to scare you out so they can buy at the bottom. That term, shaking people out or getting shaken out of the market, that's all the propaganda. It's all the trader narratives trying to scare the shit out of you. So if you have a good grasp of fundamentals of an industry and a company, you can say, well, I should probably be in cash-rich industries and companies that are in high-growth industries. Pretty basic. So where's the growth going to be over the next decade? Do you really think we're going to see a lot more oil drilling or natural gas drilling or coal getting dug out of the ground? Not going to happen, at least not in the next 2.5 years. And by then, all the car companies will have been tooled up to make EVs. They're already halfway there. They can't spend on both. That was one of the things that an executive from Ford told me. He was a C-level executive at the CES conference in 2020. He's got a better position now. He said, look, we have to make the transition to the future because we can't afford to operate in the past and the future. Can't make both ICE vehicles and EVs. Don't have the CapEx. Don't have the money. It's just way too much overhead. And that's why Ford pretty much got rid of all of their sedans in the ICE categories, and they introduced the Mach-E. And now they're going to have an electric Explorer. They're going to get rid of the ICE Explorer, and they're going to have the EV F-150, which is the most popular vehicle in America, transition all the other models to hybrids. So your F-250 and 350, which will be for work, people really doing work, will be hybrids. And they're advertising that, and they're probably going to be diesel hybrids, and they're advertising that as a way to have a power station when you go to work. Hey, bring your giant battery with you. Run your tools off it. All these things that are changing, you need to keep in your mind when I tell you certain stocks to buy. I've had 24 10-baggers for a reason and all kinds of triples and quadruples and everything else. That's why I shut my office down in January 2016. I didn't need it. You know why? Because I barely take a client here and there. If somebody doesn't read my work, I don't even talk to them. I refer them to my uncle's firm. Oh, they need hand holding and they don't understand. I don't want to work with them. It's too much work, too much liability. But I do know this. I'm really good at picking out these stocks. And now that the world is going to have at least a breath of normalization, and I've gotten much, much better at reading the Fed and the Saudis. If you really want to be in every single trade, I'll tell you if you ask about it. But I'm just going to give you my best ideas. And my best ideas are all wrapped around what's going to do good over the next 10 years. Do well. Do good. That's a very Midwest way of saying that. I catch myself with some of my Scotty accent and phrases once in a while. I crack myself up. But I think that, and I'm responding to a lot of comments here. I think that the idea that utility stocks, I want to be in utility stocks. I get an extra 2% of income. Or I want to be in this commercial REIT, or I want to be in this REIT, or I want to be in that thing because I get a little bit more income. Look, I can give you better companies with better stocks, and we can just trade some options around them, sell some options on them. I'll give you double the dividend of what these dividend companies are. There was an article on Seeking Alpha a while back that talked about something about high yield opportunities or something. And I read the article and I was just like, my God, why do you think stocks have really high yields? I mean like 7, 8, 9, 10%. Is it because they're making that much money? Or are they somehow returning capital on a business that's not particularly growthy or stable? Almost all high yield stocks, almost all, there's a study on this, lose 50% within 5 years. Yeah, but I made 7% a year. Well, you just lost 50% in a year. Well, plus 7, plus 7, plus 7, plus 7, plus 7, minus 50. So you take a look at that and you think to yourself, what stocks have done the best over 5-year rolling periods going back to eternity? And it's pretty much always the stocks that have more growth and they can translate that into cash flow. So there's 2 ways to find those companies. And one of them is happening right now. There are high cash flow companies that aren't growing a lot. They're growing 10, maybe 15% in some cases, 20% maybe, a couple of the cloud companies, but you're 10 to 20% growth stocks. And they're getting cheap right now. And the only time those companies, your Googles, your Apples, your Microsofts, Amazons, the only time they get cheap is when the whole market sells off on a liquidity event. Because otherwise people just keep on dollar cost averaging into their 401k funds. And those are weighted to the biggest stocks. But when you have an event, when you have a bear market and those stocks get cheap, for sure you want to buy them. You absolutely want to buy them. But they'll still never grow faster than the small cap stocks that are earlier in that process. Imagine if you bought Amazon, Google, and Apple 20 years ago. I think Google was already public. So you want a mix of stocks, your large cap, more stable fortress type companies. And then you also want small and mid cap stocks that are going to replace probably way over 100 S&P 500 components over the next decade. And that's what I refer to as the great divergence. You had so many stocks, the companies got bailed out by the Fed basically in spring of 2020 when the Fed supported the entire bond market and allowed all these companies to extend their debt at low interest rates. Well, starting in 2025 and 26, those companies have to renegotiate their debt. They have to stretch it out. And in most cases, the rates are going to be 2 to 3% higher. Well, they couldn't afford the debt they had before when it was 2 to 3% higher. What makes you think companies that don't have growth or are shrinking are going to be able to support interest costs that are higher? They're not going to be able to. And therefore, the equity in those companies will shrink. And in most cases, the equity in those companies will shrink somewhere between 30 and 80%. 30% will be the best case scenarios, just based on the length of the bonds, the expenses, things like that. Your companies that are actually shrinking already or are in long-term secular decline oil are really going to have a big problem. Remember, I said demographics are destiny. So you can follow the political carnage and the stupidity on both sides all you want. I'll just tell you this. Demographically speaking, the tailwinds are behind the Democrats based on age, race, sex. The only group that supports the Republicans en masse are middle-aged white guys and old white guys. And I'm not saying that because there's anything against middle-aged white guys and old white guys. I'm a middle-aged white guy that's about to become a old white guy. But demographically speaking, the shift is a slow shift to left to center. It's just the way it is. You can fight it. You can make the good fight. You can try to pull people to the middle like I do. Try to call out corruption like I do. But it's largely a waste of time. I'll spend my 20 minutes at the ballot box every other year. I'll write a few pieces because I'm kind of good at it. But when it comes to investing, focus on the big secular shifts. And if the politics are moving slightly to the left long term, even if they tick to the right from time to time, that means that all those policy agendas get put into place and they're hard to take away. It just is. And anytime something does get taken away, there's just a horrible snapback. So what is one of the big things that's going to change? It's going to be energy. People all over the world are seeing climate change firsthand. In the United States, we have wildfires in 11 states right now that are suffering from drought. Michigan, which is surrounded by Great Lakes, has wildfires because the carbon content in the air is a little bit higher than it has been historically. It happened fast, different things, right? I'm not going to explain it all, but we know that things have changed. And we know there are big efforts by companies like Chevron to clean up the way that they do business. Exxon is getting pushed in that direction by some activists who I think probably saved that company. Had they just kept going down the fossil fuel road, Exxon would have been toast. But Engine Company 1 came in, took board seats, changed policies, and impressively have got the executives to stop stealing as much, which is, one of the biggest problems of corporate America is the C-level executives somehow get paid 100 times more than C-level executives anywhere else in the world, despite shareholders, not getting money rained on them. So this all came out of growth. If we believe that demographics are destiny and all the evidence points in that direction, and it always has, then that means the Fed is going to probably have to back off because aging demographics clearly demonstrate that there is a secular economic headwind from aging demographics that's going to last for decades. We're 15, 20 years into it, and we probably have 30, 40 years to go, maybe longer. Millennials live to be 100. You have to figure out what the median death age is, blah, blah, blah. How many babies are going to get born in the future? How much work the robots do? If aliens land and we have 1 million aliens living here at some point, who knows? But growth is probably not going to be super fast across the entire economy. It's only going to be super fast across the parts of the economy that have sustainability driven change. Fourth industrial revolution, clean energy, things like that, or cleaner energy. Shouldn't always say clean energy. Sometimes you just have to say cleaner because that's an incremental improvement. And it's one of my biggest investments. So if TLT gets in this range, my guess, it happens here in the next couple of months, TLT will probably be a buy in the lower 100s, would be my guess, or right around 100. The only way that it keeps heading down here is if inflation is just so scary that they have to push rates up. And then this will be a very V-shaped thing. This would actually be the easier trade, right? Because then it would snap back when the inevitable quantitative easing comes. Somebody mentioned to go to ARK's YouTube page. Apparently, they say a lot of things I do. Yeah. One of the things about Cathie Woods, because since we sold puts on that recently, is that her themes are right. There's nothing wrong with her themes. Nothing wrong with her research even. But one of the advantages you have as an individual investor is you're not subject to the rules of funds, of the Securities Act that regulates how funds operate. A fund has to state a thesis, basically how they're going to manage the money. And then they have to stay within those lines. It's very hard for them to color outside the lines. And it's very hard to get approved to do certain things without just overwhelming regulatory oversight and cost. The financial industry, and this is one of the reasons I run my business the way I do, the financial industry is basically skewed against you. The financial products that have gotten sold to people for years, while better now, still aren't great. ETFs, because we can trade them during the day, is a big deal. But the reality is that there is just such a huge mountain of shitty financial products out there, peddled by know-nothings who only see the income because they're taking just a huge cut to sell you that product that you don't need. But the rules for ETFs and mutual funds are pretty tight. So when you buy an ETF, even a managed ETF, you have to understand that it's a pretty narrow path that they have to travel. So if their entire category is getting beat up, nothing they can do about it. I believe there's a maximum that Cathie Woods can go to cash, right? She can't go 60% to cash like we did. So she just keeps buying her favorite stuff on the way down and doing the best she can. And then you have people who are betting against her to make the ETF go down more, which is why I've been real interested in it lately, because it seems to be in a basing pattern. My limit orders to buy it are at 35, and when it gets back into the 30s, I'll sell puts, because the companies in there are good companies, some cases great companies, and the market has rewarded them. And relative performance, right, should be your number one issue. I don't want to just buy a stock that's okay because it's pretty good. And I get those questions. What do you think about this? I heard somebody say, or I read something that Altria might be able to turn themselves around. And then they have a rally. Oh, look, they're doing it. Nah, it's just rally. Companies in secular decline almost always stay in secular decline. It's very rare that management turns things around without a major kick in the butt, like at Exxon. So I'm going through this because I want you to understand why I give you these ideas. And again, a lot of you are new. So when I say buy a Metis, or that I'm making it a rare double position, you need to understand something. I almost never make anything more than a 3% position. Almost never. I did it most recently with AT&T because I think that the Warner Brothers Discovery merger is going to be the biggest thing since streaming. Haha, it's kind of a joke. But I remember how cable TV, select TV, and HBO all started. It's all supposed to be about saving you money because you could buy a la carte. And what do we know? We now know that if you buy as much content through streaming as you had with a really good cable package, you're paying more. So now the streaming companies have to somehow maintain their revenue, pay for the content. In a world where advertising income more and more goes to the online guys, Google. And how can they do that? Well, consolidation. So that's what's going to happen. Why do you think, and I'm gonna write this in an article just to get a bunch of people calling me arrogant. Why do you think Warren Buffett followed me into Paramount? Wow. When did I tell you guys all to buy Paramount? When it was still called Viacom. And lo and behold, in the last quarter, Berkshire Hathaway started buying it. Comcast is the other one. I don't know if Berkshire owns Comcast or not, but if they don't, they might at some point. Because Comcast can do a similar deal as AT&T. They can spin off NBC Universal, get some spiffs out of the deal and a bunch of money and a bunch of debt relief. And then NBC Universal spun off maybe to Netflix. Suddenly, holy cow, Netflix has a content library. They have better resources. They're going to save money on synergies, right? Not having to have as much overlap. They get a news network out of it. So Netflix, which I haven't liked in years, I think NBC, Universal, and Paramount are in play with them. So I want to own all of them. And I don't own Netflix yet because it's not down to where I want it to be. When Netflix gets down to the right price, we're going to want to buy it because streaming is everywhere. Somebody asks, when's Warner Brothers and Discovery going to launch their combined packages? Well, I think you're just going to have two. You're going to have HBO Max and you're going to have Discovery Plus. And when you have HBO Max, it's going to say, would you like to add Discovery Plus for a $5 discount? And when you have Discovery Plus, it's going to say, hey, would you like to add HBO Max for a $5 discount? That'd be my guess. I think CNN will end up on HBO Max either way. I think CNN, they're going to figure out different ways to distribute it. And now that their own streaming thing didn't work, which was a bad idea in the first place, it was too little. All these separate apps like TNT and TBS and AMC, I don't even know who owns that one. I think they might be their own thing. But when you go to your Roku or your smart TV, it has all those apps. Those will basically all be ad supported. And if you want it to be ad free, you can either pay for that in the app or you can pay for it in a bundle through HBO Max or Paramount Plus or Discovery Plus or whatever. I've got them all. So, I just click on my Roku TV and I find it. And the funny thing is I'm looking at TVs. I'm not really looking at Rokus because you don't really need them anymore. So that's the question somebody asked about Warner and why we buy things like that and how my thinking goes when I'm looking for something. So in the case of a Metis, I'm building this double position, which is super rare because I think it's got monumental upside. What does America need right now? It needs more refining. It needs more jet fuel. It needs more diesel. These guys have the most growth in that space anywhere in the country. More than Chevron or Exxon or anybody, or Marathon Petroleum or Valero. This is all brand new capacity being built right now. And it's basically carbon neutral. And these guys bought a massive cavern in California underneath an old military base where they can sequester carbon. They can do carbon capture. And the nature of their business is that they're going to make as much money and margin as your Chevrons of the world. But because they don't have any of the other legacy high carbon business, oil and gas, the tax credits basically are going to increase their margins by 50 to 200%, depending on exactly how that all works out. So at the most conservative end of how the tax credits work, this company is going to be uber profitable in about 3 years. We'll probably cross the 5 billion threshold in total revenues by 2025 or 2026 and have $1 billion of revenues per year at that point. The company trades for 300 million right now. Well, but what if it goes to 200 million? I'll buy more. I'll make it a rare triple position. Think about 3, 4, 5 years out, not 1 or 2. That is the best advice I can give you. And in the very short term, you can do little mini tradings and sell some options and marginally add around the edges. Your super big money isn't from this relatively huge premium that you're going to get, which implies some risk, just like high yield stocks do. The real big money here is that this $7 stock might go to between 100 and 200. Now, the last time I said that with a single digit stock, well, actually I said it about Enphase. So time before that, Exact Sciences. Right, anytime you say that about a single digit stock that can go over 100, people think you're nuts. And yet it happens over and over and over again. And they have similar characteristics. They're doing something that is an unmet need. In biotech, it's actually called an unmet need. Well, right now, finding more jet fuel and natural gas for trucking and diesel, biodiesel, is an unmet need. That's why we have so much inflation. These guys are walking into like the sweetest spot they could ever walk into. Teladoc, on the other hand, was a go-go darling that probably is 50% below where it should be. I mean, I think you're probably legitimately buying it for a 50% discount to what their revenues generate, right? Just based on what they earn, Teladoc should be double. How much bigger of a coupon do you want? Oh, but it might go down a couple more dollars. Whatever, so will Apple. Are you gonna throw Apple out? Granted, not the best comparison, but when you can get a 50% discount, you should buy it because you know what? A big company or some super rich dude is going to buy it too. And that's what my quant charts are all about. Where do the super rich folks start to buy it? And TDOC is right about here, 10% premium for 2 months. If it gets put to you, hey, great, you get the upside. It's pretty close to the bottom, that's fine. If it goes up in the next 2 months and you just get to keep a 10% premium for 2 months, 10% for 2 months, 60% annualized, that's all right, especially in light of what's going on in the market. Stone, Brazil, FinTech, Berkshire Hathaway owns this one. It's below the IPO price of a few years ago. Brazil is a powerhouse, folks. Big population, resource rich, good tech, good demographics, got some political and legal issues. And if you're American, you got to be careful to go down there. Stay where you're supposed to stay. Probably hang out with people, take care of you. But FinTech down there, it's growing fast. The entire emerging market world, FinTech is growing fast. So if you don't own Stone at this point, and you want to own something that Berkshire Hathaway owns and might be buying more of, take a starter position and then sell some puts so that you buy it incrementally lower later in case it goes down a little bit more. In all these cases, I almost always have a starter position. In Teladoc, I don't. I'm just selling the put. Stone, I have a starter position. PayPal, I have exposure through funds. And PayPal is, I think, if you just take a look at the last 3 months, really starting to plateau nice, just in this channel. Doesn't mean it can't fall down out of bed one more time. I mean, my goodness, if this stock went back down to its IPO price, that would blow my mind. I actually bought PayPal on the IPO, and then I was a moron, and I sold it at about 100. And everybody teased me when I went over 100. Well, there you go. Now it's back to 81. And time has elapsed. The business has gotten better during that time period. More cash rich. A little less growthy, still pretty growthy, and it is a huge takeover target. Visa, I think, is the one most likely to buy it. Could be Apple, could be Google, but PayPal is a massive buyout target. And that is one of the things for the new folks. I talk about potential M&A all the time because companies that go through M&A, it's like 78%, it's almost 80% of the time, do very, very well. Either they're getting bought out Or in the case of mergers, it's over 80% of mergers result in a higher share price down the road. So if you know things like that, you just keep doing it, right? Mark Cuban once said on TV, he goes, somebody asked him the secret of making money. He goes, find one thing that works and just do it over and over and over and over again until it doesn't. Getting involved in M&A deals is that sort of thing. I look for them religiously. And I look for tomorrow's technology that's just starting to grow today. One company that I missed that's in the news right now is VMware. I had a tech guy here in Milwaukee telling me about VMware 20 years ago. And whenever it went public, it was, I think, the early 2000s. And I think he had it in his account when it transferred over. And he said, don't sell it. I was like, okay, I won't sell it. In any case, VMware, right? Take a look at their history on M&A. Up and down, but in the long run, up. And who ended up taking it private years ago? Michael Dell. So when I say that a rich guy or a big company might be interested at a certain price, you take a look at my quant charts, right? I'm using these volume studies to let me know where the rich person interest is. In my mind, rich guy is male or female. The rich person, right, is a short for person, start to get just huge interest from the big institutional investors and the family offices, and then the billionaires, the billionaire class, the private equity firms when prices get super low. So there's a lot of cherry picking starting to go on right now for the beat up companies. You should keep an eye on that. And what do we know about certain companies? We know that Apple can only go down so much before Berkshire Hathaway starts to buy it again. So what did I say? I said, if Apple gets around 120, we got to look at buying it. And it looks like it might. Apple gets in here, you take a bite, and if something weird, bad, horrible happens to the world and it goes down here, you go get yourself you pick a peck and you get a whole bunch of them. Microsoft, same thing. Google, same thing. Amazon might be almost there. Yeah, Amazon is just about there. Then, of course, you can just buy this, QQQ. And then there's a couple of little itty bitty funds that only have like 10 stocks. And, it's just like the top 10 and NASDAQ. Those are out there too. But I like QQQ. I like getting the diversification of the whole basket. All right, what kind of questions do we have here? Yeah, somebody talks about Ametis. Oscar, you're in California, right? Brandon's up in Portland, I think. Yeah, go read what Ametis is putting out, folks. I've been pounding the table on this one for 9 months now. I first brought it up about a year ago, and I would tell you that it is. They're in just such a sweet spot. They are. They're going to probably get bought by Chevron way before I want them to get bought. Like some of the other companies that I buy them, and I make my 50 or 100% or 200%, but I'm sad because had they stayed private just a little longer, right, it could have made a lot more. But, that happens. Somebody asked, where would I buy QQQ? Well, so if you read the article, this one, right, I talk about it, right? So under 272, right, that's pretty much the best case scenario the shooter and I can see. And we both see kind of that 220s to 240s as a likely bottom. So, it's really hard not to buy under 240 because the only way it goes down here is we would have to get something really bad. Now, I haven't written the article yet, and I'll maybe get to it tonight. I'm going to try. Here's the scenario that I'm afraid of. I'm afraid that China sticks with zero COVID policy. I'm afraid that the next assassination attempt of Putin, results in him coming back stronger. Apparently, there was an assassination attempt. I don't know if that's propaganda to somehow make people feel sorry for him, but there's a lot of chatter out of Russia right now. But if something bad happened with Russia, or if for some reason there was another oil shock, deliberate or accidental, in those scenarios, inflation stays higher for longer. The Fed has to become more aggressive. But if you were watching the Davos reporting today on Bloomberg, did anybody catch what Stiglitz said? Big time economist, right? Writes a lot of textbooks. Stiglitz said exactly the same thing I've been telling you for months. The Fed can't get too tight, and the central banks can't get too tight because it'll kill the supply side. And that's what we need as fast as possible. It's more supply. So the better approach is probably to let interest rates stay low, to reverse course once the stock market corrects. Because as I've told you, I think that really the Fed's main goal is really just to prick the stock market bubble that we clearly had before it got to the point where it became systematically destructive, like the financial crisis. So once they prick this, I think the Fed backs off because I think they know what Stiglitz and economist Spano have been saying, which is you have to support the supply side right now. You have to help those supply chains move and fill out. CapEx is going up in the oil and gas market. The rhetoric isn't that. The narrative isn't that. Go to the EIA, the chart's right there. CapEx is going up dramatically. We're going to have another 1 million barrels of oil by the end of the year per day. In Venezuela, something over there is going to get rebuilt. I mean, they might not get back to where they were a decade ago, maybe ever, but something over there will get rebuilt, and that market and that oil will support them at home and get sent overseas. I don't know how they'll work out the deal. Maybe the first 500,000 barrels stay at home, or they do some sort of an exchange with us for light sweet, because Venezuela is 500,000 barrels a day of oil short, and they're an oil-rich country. So they got to take care of themselves there. A light sweet exchange with Chevron, which is negotiating the deal. I'm sure they're talking to the State Department every hour, but they'll work something out with Venezuela, and then they're going to send teams of engineers over there. They're going to figure out which field or fields they can get up and running the quickest, because there's a lot of damage. But that might take some time. I think that we'll get a shipment from them by spring, and we'll be hearing about it sooner. And if that's the case, and Iran knows that it's coming, and Saudi Arabia knows that it's coming, and the UAE knows that it's coming, they're going to get oil on the market sooner. So Venezuela is an important pressure point for oil. But if going into the end of the year, inflation is still 7, 8, 9, 10%, I don't know if the Fed will bow to the pressure of being tight, right? I don't know where Powell is, but I do know that he is a flip-flopper. So we got that going for us. There's a chance. And I will stick with my prediction that the Fed backs off by autumn, probably at the September meeting, maybe even throwing out hints in August if the market has gotten really bad, right? If we start showing signs of the zombie apocalypse, then the Fed might say, yeah, I don't know that we're going to increase the QT. That might be enough. And then maybe they show up in September and say, yeah, we're not going to raise interest rates anymore. Maybe that'll be enough. And if it's not, then they'll just back everything up a month later. So if I had to guess, I'd say there won't be any quantitative tightening or higher interest rates by the end of the year. They'll stop raising interest rates and quantitative tightening by the end of the year. So that all lines this up for a bear market that runs right back into a bull market. And is it too late to accumulate cash? No, I know that's a question that's out there. This rally over the next 2 or 3 weeks is when you're going to accumulate some cash. If you have ETFs or mutual funds or 401k sub-accounts that are highly correlated to the S&P 500, so basically all your large cap stuff, sell some of it or all of it. Just have a plan for scaling back in at lower price points. Don't necessarily have to try to pick the bottom. Just get in a little lower, especially that first purchase. That first purchase is lower. Now you're giving yourself all kinds of wiggle room. Have that 3-step scale in, and it'll work out for you. Then without selling all these puts, be very selective, and you can do well. Somebody asked, why am I writing covered calls on AT&T? It was a huge position, right? It was a huge position. It was like 8%, 9%, and I want to get it back down to 3. That's a normal long position for me. So I am selling the November 22 calls for $1 or higher. My cost basis is 22 and change. So that's all. That's why I'm doing it. If AT&T isn't over 22 in November, and it might not be because this is a bear market, I collect that premium. I sell it again at some point in the future. And if AST Space Mobile is successful this summer with their rocket launch, and suddenly AT&T is being talked about as a global carrier because of that deal with the satellite company. And can you imagine if AT&T suddenly can be anywhere in the world? Remember, they have the biggest cable under the ocean. They have the most cable under the ocean. AT&T is the only company in the world that could truly be a global international telecom carrier for both hard lines and 5G cell phone. I mean, think about all the business travelers that would switch to AT&T in that case, or just people who travel a lot. I mean, they're already the biggest, and they can become way bigger, like double. And again, at some point they got to compete with Roku. It doesn't make any sense why the companies that are providing internet service aren't basically providing what Roku offers too. It can all be done right on the wire. I mean, heck, they can send energy on a wire now, right? Do you know that? I talked about that a while back. Electricity is going to be coming through coax at some point, or fiber optic at some point. So technology is moving fast, folks. Somebody asked why JP Morgan and Morgan Stanley shot up today. I don't know, and I don't care. Don't know and don't care. Why would anybody in the world own a bank stock when you can own Apple, AT&T, or excuse me, Apple and Microsoft? Apple and Microsoft grow faster, have more money, and better businesses. And they don't have anywhere near the systematic risk as investment banks and big banks do. And if interest rates come down again, which they are going to, the banks do poorly. The banks are the biggest sucker play out there. Stay away from the banks and sell your oil stocks into this strength because it's the last chance you're going to get. All right, let's call it a day. I'm going to go try to help my friend because he's not doing well. All right, take care.